Good afternoon and welcome to the New Capital webinar, second quarter review and market update. I'm Catherine Barr, the Director of Communications and Marketing at New Capital. If you have any questions during today's session, you can use the Q&A tool at the bottom of your screen, and also feel free to use the chat tool at the bottom of your screen if you have any questions. We will answer at the end of the presentation. Okay, and now I'm going to get started by reading the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Thank you for that. And now I will pass it over to Leonard Golub.
Thank you, Catherine. And I want to wish everybody a good afternoon, since we're just a few minutes after noon, and hope that everyone's summer is going well. I'm coming to you from very sunny Columbus, Texas, north of Columbus, about 10 miles north, and you know, the story for so many people is this incredibly arduous summer. And so I was going to go to Massachusetts to our place up there, but decided that I didn't want to make the trip. And I'm glad I didn't, because I've been spending the last weeks just trying to keep orchards alive and yards alive. And it's all about water right now. And, you know, if somebody were to ask me, what's my biggest concern, it is climate change. The amount of money that we have sunk into infrastructure in different places around the world, including here. You know, I've got a well and a barn and all this, but if suddenly the place just dried up, what a colossal destruction of capital, and then I would have to rebuild it somewhere else. And so should be a big concern to everybody, this incredibly difficult global problem that we have. I'm seeing trees turn yellow and lose their leaves here. Blackjack oak, which is known as a very, very drought tolerant, hardy oak species that grows on poor soils, rocky and gravelly soil. And I'm seeing blackjack oak here under tremendous amounts of stress. So wherever you are, I hope you're doing well and managing to stay cool. And hopefully the world's going to try to address this problem. Just a couple of reminders. Your regular quarterly reports are available on NCM 360. We upload them every quarter there. So if you don't know how to get into NCM 360, you'll need to know how to do that to get your report. So feel free to contact Casey or Catherine to get your credentials if you need it. And then just a reminder that our annual conference is coming up. Hard to believe we're here at the end of July, and so just a 3 months away from the end of October, where we'll have our conference. We'll have it at our sister building, the one that's near the Greenway, next to the Mercedes dealership and the cinema, the Edwards Cinema. The building and the conference room that Granite Properties extends to us is a really good room. So please set the date aside, and we'll be doing the conference both in person, which I hope everyone can make, but if you can't, we'll do it. We'll have a virtual feed also to allow you to attend it. Okay, just getting right into it here, some overview slides. Year to date, it's been a positive period for stocks and for bonds, both. Here on the left-hand side, you can see that U.S. equities, about 16%, developed market equities, about 10.5%, emerging markets, more muted at 5.6%. So you can see, but all these different sectors are positive, and a complete change from 2022. And I'll show you some slides coming up about how this year is really kind of a mirror image of last year in a good way. So total global equity about 13% year to date through June 30th. And bonds also have been positive this year. You may recall that bonds had one of their worst years ever, if not their worst year ever, last year. And this year, so far, 2%, the aggregate bond index, sort of the S&P 500 of bonds, and then global bonds have done even better, 3.6%. Put it all together, and a global aggregate for bonds is about 3%. So bonds have also done very well relative to last year. Of course, not relative to stocks. Stocks up 13%, bonds up 3%, but a good strong year to date. 3% up year to date for bonds is a good strong performance. Our NCM models. What's new is the slide, not the models. But this is the first time we've put these slides up, and you can see that both for we have to have two categories for our models: those for taxable portfolios and those for non-taxable portfolios. And the numbers are very similar for both. And you can see it just goes up like clockwork. So Model 0 is all 100% bonds, and Model 10 is 100% stocks. And you can see it's just gone up like clockwork. A lot of people hold Model 6, Model 5, Model 6, Model 7. So your portfolio is done anywhere between 8% year to date to 10% year to date. And if you hold 100% stocks, and we have a few of those, not a huge number, but 14% returns for the year. 2023 versus 2022. We'll start with a few slides here that show you the difference between the 2 years. This is the U.S. dollar, and look, the U.S. dollar through July of last year was up 11%. This year, down 4%. So, been a big swing, and you can see that it's a mirror image. Dollar was up last year through July 20th and down this year. And you can see that the dollar peaked, I don't know, September of last year, 19% up versus a basket of foreign currencies, and ended the year, the dollar had weakness that began after this peak right here, but ended the year up 8%. Commodities. This was the early spikes due to the war in Ukraine, and look what's happened since then. The year ended with commodities up 19%. 2022, that is to say, ended with commodities up 19%. This year, commodities down about 1%. This is the Invesco Commodity Index total return. And so you can see that from the peak, commodities have fallen, quite steeply. Who could have imagined that 1.5 years after Russia invaded Ukraine, we're actually substantially lower in commodities? And so it makes it very dangerous to make predictions about where prices are going based upon any current event. Value versus growth. Last year, value was up 31% versus growth at the end of the year. So value outperformed growth 31%, by 31%. It's a tremendous amount. This year, totally the opposite. Growth is back in control again, and growth has outperformed value by 20% here through the middle of the year. So total change. If you thought that 2023 was going to be a repeat of 2022 when the year began, you were totally wrong. And then look, here are these mega caps, right? Microsoft, Apple, Google, Amazon, Netflix, Tesla, Facebook, and NVIDIA. This is how they did. The red is how they did last year, right? Some pretty big negatives. Tesla was down 65%, up 137% this year. And many of you know about NVIDIA. on this AI craze that's going on. NVIDIA lost half its value last year. So your stock got cut in half last year, and here it's tripled here in 2023. So complete mirror opposite 2023 versus 2022 in the area of these large cap, many of them tech stocks. Okay, on to some economic readings. U.S. inflation. This is a heat map, and this is going back to 2021, and this is monthly. So each month you're getting a different color coding for the inflation readings, and you can see back in June of last year, we were really in it with high inflation, 8.9%, and that is where inflation peaked. And you see steadily each category, gasoline, electricity, utility, pick your category, you can see that for the most part, we've gone from red alert to a much more benign green situation. We still have some inflation in the used car market. So April, we still had 4.4% inflation in used cars, and May also. But look, the most recent reading in June, we actually even had used cars back off in their price increases. And so across the board in the most recent reading, we don't have any orange and we don't have any red at all. It's all anywhere from yellow to green. And the inflation, the inflation picture, much more benign than it was back in this time. Recession determinants, the recession that everybody has been waiting for and expecting. It may or may not materialize. You can see that in the most recent month where we had full readings, the only area where we had some very strong concerns in terms of month-over-month change in the recession reading value was in industrial production, which went from green to light orange between April and May, and now has gotten here in June, or the most recent reading in June, even a little more orange. We haven't gotten readings yet for consumer spending or retail sales, and the overall reading we haven't. But these two readings, non-farm payroll employment and household survey employment continues to be strong, and the picture here has even gotten better from May to June. So we'll have to see whether we get a recession that develops or not. But impossible to predict. But so far we are not in recession. Fed raised interest rates, the federal funds rate again yesterday, and you can see that it has been a really historic series of rate increases beginning here, right? These are the changes to the Fed funds rate. And, we're now north of 5%, but this is what's expected in the future. So the Federal Open Market Committee, the FOMC year-end estimates are for these future amounts. So year-end 2023, they expect to be at 5.6%. And then in 2024, they expect to see 4.6, and 2025, 3.4. And you may say, well, does the market believe that? Well, yeah. Here, the green and the green dots and the green markers are what the market expects. And you can see that the market expectations are pretty much in line with what Fed estimates are. So we'll see whether we begin to see decreases in the Fed funds rate toward the end of this year and into next year. Yes, we've had another increase as of yesterday, and we may get another one before the year is out. But thereafter, this is what the picture is for the Fed funds rate. Doesn't continue to go up, right? You can see that. It falls off and falls off fairly steeply. Let's take a look at the stock sector. This is consumer sentiment and the stock market. And you may remember at the last quarterly webinar, I talked about this and how in an uncanny way, every time consumer sentiment hits these lows, we get pretty strong stock market performance. And conversely, every time consumer sentiment is exuberant, we get falls in the stock market. And here we were in June of 2022 with very, very low consumer sentiment, rivaled only back in May of 1980. We did not have a reading of consumer sentiment that low, for 40 years. And look, stock market turned around, and this is where we are now. In consumer sentiment, stock market turned around, it's had an 18% gain from this point in this really very, very deep trough on consumer sentiment. So very often consumer confidence can be an inverse indicator for what stocks might do. When consumers get overconfident, generally is a bearish signal for stocks. And when consumers are very pessimistic, it can be a very bullish signal for stocks. So don't let the headlines about how consumers are feeling influence your investments. You could pay a steep price for that. The usual chart I show, annual returns and intra-year declines, right? So this was 2022. There was a 19% decline in the S&P 500, and at one point last year there was a 25% decline from the high point. This year we're up 19%. So again, total opposite of last year. 19% was where we ended the year last year down, and we're up 19% year to date. This is the S&P 500. More S&P 500, and this is looking at several different measures. Where are we as of July 25th, just 2 days ago? These slides are courtesy of our partners at JP Morgan. 19.6 on the price to earnings ratio, not cheap, right? This run we've had has put stocks back in a more expensive footing, and you can see that there. And right now, we're trading at 19.6 times earnings and a dividend yield of 1.6%. This is on the S&P 500, and a 10-year Treasury bond, 3.9%. And this is where we were a year and a half ago. So you can see that the big change is here in the 10-year Treasury bond. 1.6% was the yield on the 10-year Treasury bond in January of 2022. And here we are. It's hard to imagine, over 2% more on the 10-year Treasury, stocks trading at the same valuation, roughly, as that prior time period. So there it is. Forward PE ratio. You can see stocks, U.S. stocks, because that's what the S&P 500 is. We're going to talk about international stocks in a second. You can see stocks are more expensive now than they were a year and a half ago. Right? Very clear. We were trading at around 17 times earnings or so, even below that, 16, under 16, 15 something times earnings, and we're back up close to 19 times earnings. So it's great that stocks have gone up. I know that makes everybody feel good when they look at their statements, but the corresponding issue is that valuations are not as inexpensive as they were before. Recent returns, this is always a busy slide, but I like to slow it just to highlight some different things. Here's year to date, and you can see growth has now way outperformed year to date. Value's done well, and the blended stocks have done well as well. We're not going to sneeze at 8.6 and 9.4%, 7.8, but it's been the growth section of the market, which has in some ways been dragged up by this craze over artificial intelligence, which has really put some boost into a lot of growth stocks. And so that's what's gone on over year to date. But as we know, the leadership can change at any point in time. And you can see that since the market low of March of 2020 during the pandemic, when it was really just getting going, the pandemic, we've had several areas where value is actually outperformed. So value in general has outperformed growth since that point, but leadership has changed. And then here is the current PE as a percentage of the 20-year PE. This gives us some idea of, are things expensive or cheap in these particular categories? And you can see large cap growth is trading at 145% of its 20-year average PE versus small value trading at 93.6%. So, always a concern when you get these sorts of very high valuations. International. Well, where are we? Well, international is now trading 2 standard deviations cheap in its price to earnings discount versus the United States. So look at that. We're now getting in July of this year, 2 days ago, a 33% discount on the price to earnings ratio of international, all country, ex-United States versus the S&P 500. So why do I continue to make investments internationally? For many reasons, but this is one of them. It's just a lot cheaper. And this is a way to diversify away from more expensive sectors of the US market that I was just talking about in the prior slide. And you can see that the dividend payment on international stocks is substantially higher than versus US stocks. And that's almost hit an all-time high, right? So this is the dividend on the all-country world ex-US minus the S&P 500 dividend. And so you're getting paid 1.7% higher dividend on international stocks than you are versus US stocks. And that difference between the dividends is 2 standard deviations, meaning very abnormally high versus the average. And so the valuation on international stocks is very abnormally low versus the US, and the dividend payment is very abnormally high versus US stocks. More on international. These are periods in purple where international has outperformed the US, and the gray are periods where the US has outperformed international. And you can see this has been a long run since 2008 of US outperformance, the longest run dating back to 1971, but every dog has its day, and we'll see. Here is the last 1.6 years when we begin to see a little bit of outperformance of international. So we'll see. My prediction is international is going to outperform the US just based on valuations, right? Just based on that. But we'll see if this continues. Maybe it does, maybe it doesn't. And then new, this is a new slide I'm showing. This is courtesy of Dimensional, and you can see that year to date, here's the US. So it's had a good year, but other countries have actually had some outperformance. Germany has outperformed the US year to date. France has, Spain has, Netherlands has, Italy and Ireland has. What's the theme? Europe. So Europe's in a good period right now, and just below that's Denmark, Japan had decent performance. Here's Switzerland, right? UK, Canada, all positive returns. Portugal all the way down until Israel, negative return, Finland, Norway, and Hong Kong. So these are the only handful of countries that had that are developed markets. These are developed markets, so the only 4 developed market countries that had negative performance year to date were these. And then here's emerging markets. Look at Greece. You could argue if Greece is an emerging market or a developed market, but anyway, 50% performance for the Greek stock market. Total turnaround. You may remember several years ago, almost 10 years ago, really, Greece had very, very deep economic distress. Its bonds were defaulting, and it was in an enormous amount of trouble with the European Union and the loans that had been made to it, and really went through an incredibly wrenching period. Greece is doing pretty dang good. I was lucky enough to visit there, was it last year or 2 years ago, and loved it. Now, they have a wildfire problem there. You may have been reading about some of the really deep climate problems that are occurring in Southern Europe, and that's happening there. But right now, it's not only Greece that's on fire, but it's stock market too, up 50%, and that is by far the best performing stock market in the world, and you have exposure to it through New Capital. Hungary, Mexico, Czech Republic, Poland, Taiwan, Brazil, Peru, Korea, Saudi Arabia, India, Indonesia. And then we get some negative performance out of Egypt and Qatar and Kuwait, China, South Africa, Malaysia, Turkey. Turkey was the world's best performing stock market last year. This year, down 20%, worst performing stock market. So that's how things go. That's why we diversify. And then sector returns year to date. And you can see it's a complete opposite. Last year, energy was the best and I think only positive performing sector last year in 2022. Energy was it. Everything else was negative last year. This year, energy goes negative. And tech is having this very, very strong year, but not the only year. Communication services. This may have changed recently because this is through June 30th. And I think in the last few weeks, the telecom companies have announced that they have some legacy problems with lead cables, and that's hit their stocks. But at least before that, very strong performance for communication services, consumer discretionary, things like automobiles and large appliances. Here's real estate. Look at real estate. We've heard a lot about the problems in the office market, and yet real estate's having a good year. Compared to some of the others. Here's REITs, here's other real estate. And so you put these two together and it's not a bad picture. It's actually outperformed healthcare, outperformed financials, outperformed energy, outperformed consumer staples, outperformed utilities. So pretty good year for real estate. And what you can see here is that this is the performance in developed markets internationally and emerging markets. And you sort of get, you can see that sectors kind of perform in line, even across geography. It's not exact, but you can see sort of similar types of performance profiles for sectors. Okay, looking at bonds. This is the Bloomberg US Aggregate. Again, the S&P 500 of bonds. It's an index that includes treasuries, and it includes corporates, and it includes agency bonds and other bonds as well. And it's intended to give you a general picture of how bonds are doing. And you can see the terrible year that bonds had back in 2022, down 13%. And at one point last year, bonds were down 17%, much better this year, up 2% year to date for the aggregate bond index. Although at one point this year, earlier this year, bonds were actually down 4%. So, and you can see that each year there are periods of downdrafts in the bond market almost every single year. 2% down, 5% down, 4% down, 7% down, 9%. And yet the markets, the bond markets have ended positive most years. You can see that in the gray. Most of the time the bond market delivers positive returns, although of course it did not last year or the year before. Here's the yield curve on the Treasury, and you can see that it has barely budged at all between the end of last year and the beginning of this year and now. Look at that. It's the blue line and the green line are in lockstep. The green line is the end of last year, call it New Year's Eve, if you will, New Year's Day. The only change has been short-term rates have increased. And our management of your portfolio has given you the benefit of this because we have leaned highly towards short-term duration in the portfolios, and so you've gotten the benefit of this increase in yield that's occurred. But look at the difference versus 2021, right? 2.5 years ago. We're in a completely different interest rate environment. I know everybody knows it. I know you know it. I know it. Who doesn't know it? But it's another thing to sort of see the incredible difference in short-term rates, which were 0%. And now look where they are. This is a staggering change, everybody. Look at the difference there between short-term rates now and short-term rates 2.5 years ago. An even bigger difference than between long-term rates 2.5 years ago and long-term rates now, although that is a big difference too. 1.9% on the 20-year Treasury bond versus 4.1%. On the 10-year, 1.5% 2.5 years ago versus 3.9 now. On the 7 10-year, 1.4% 2.5 years ago, 4% now. Staggering difference in interest rates. 5 years on the Treasury bond, 1.3% versus 4%, and way out here, 30 years, 1.9% and 4%. So huge changes since this time, but really we haven't seen much change at all in interest rates this year to date, except here. Interest rates and inflation. We can see right here where we are. There is still a big difference between nominal rates and real rates, and the difference is inflation, right? The nominal rate, take away inflation, the nominal rate 3.9% here on July 25th, 2 days ago, add in a 4.8% interest rate reading, and that gives you a negative real yield, right? So that means that the 3.9% on the 10-year Treasury is not earning enough yield to pay for current inflation. But if inflation goes to 3%, then it is, right? But right now we can see that there is a negative real yield right here, although it's creeping up towards zero. It's been creeping up from this low right here, where we were highly negative in real yields. The yields on bonds were so low and inflation was so high that we weren't coming close to earning a yield that made up for inflation. This is fixed income yields across all different kinds of bonds. And the takeaway here is this is the current, the dark blue diamond. And so for each category, this is US Treasuries. We are trading over the past 10 years at a high, near a high on Treasury yields. And you can see the 10-year median, the middle observation of the data, is way down here, 1.6%. And so we are well above what the median reading over the last 10 years is. And it's the same thing for all these different kinds of bonds. Municipals, current yield 5.8% versus 3.9% median. And this is the 10-year range from the highest reading to the lowest reading. And you see that we're near the higher point of all the readings. Investment grade corporate bonds, mortgage-backed bonds, asset-backed bonds, things like car loans, euro-denominated investment grade, emerging market dollar-denominated bonds. Look at that, 8.2% on that yield. Emerging market bonds denominated in local currencies, emerging market corporate bonds, emerging market high yield corporate bonds, US high yield bonds, and leveraged loans, which are corporate loans that are securitized often against assets of a corporation, 11% yield right now. And all of these bonds are trading toward the higher end. So you can see we are in a different interest rate environment for sure, not just in treasuries, but across the entire spectrum of bonds. Okay, let's look at asset class valuations as I move to conclude here, and then we'll take Q&A in just a few slides. We're looking at all kinds of different assets, treasuries, and so on. And this slide is ranked from least expensive, if you want to think about it that way, to more expensive. And this is the current reading, is the dark green dot, and the, I don't know what you call that, light green is a diamond. And that is as of the end of 2021. So 2.5 years ago, this was the reading on the expensiveness of the asset class. And so in yield to worst terms, yield to worst is a measure of bond valuation. Treasuries right now are trading at a much greater undervaluation than they were in the end of 2021. One standard deviation away from the mean and the least expensive of all these different categories in comparison to prior valuations on treasuries, and very noticeably different versus the valuation on treasuries at the end of 2021. And we're holding quite a bit of treasuries in the portfolio for you to take advantage of this. US core bonds also looking relatively attractive. And I'll talk in a minute about some moves that JC and I are probably going to make in your portfolios in this area of core bonds. Developed market equities, excluding the US, so Europe, Japan, etc., also relatively undervalued. And I've talked about that today with the other slides I showed you just a few minutes ago. And that's borne out by this reading here that it's less expensive on the forward price to earnings basis. So this is the third least expensive category. Emerging market equities on a price to book basis, also looking less expensive than its 25-year average valuation, and certainly less expensive than where it was at the end of 2021. Municipal bonds were way expensive. Look at that. At the end of 2021, much less expensive now, trading more toward the average valuation for municipal bonds, but still a little bit undervalued. US small companies, little bit above the 25-year average valuation, but below where they were at the end of 2021 and within a range. US value stocks, a little more expensive after we've had strong performance from US value. And so trading at 0.51, not significantly expensive to its 25-year average valuation, and less than it was in 2021, but it is above the 25-year average. US high yield, getting a little expensive there, one standard deviation beyond the average, and roughly equal to where it was at the end of 2021. And then US large companies starting to get into much more expensive territory, about to pass the one standard deviation mark here from the average. And then same thing for US growth stocks. So this is the more expensive end of things, which now includes US growth and US large cap and US high yield bonds. And the less expensive side of things, treasuries, US core bonds, and developed market equities and emerging market equities. All right, this is new. This is a report card I'm giving to New Capital in the asset management side of things. And I'm just trying to think about it and go through it and say, all right, I'm looking back and see, how have we done taking a look at the economic outlook? I'd give us an A on that. We have been, and JC and I have worked on this, we've been sort of, I don't know about pessimistic, but we haven't been willing to trade the portfolio out on fears over a looming recession. We've thought the job market was going to continue to be strong, and we thought that inflation was going to continue to be a concern to the Fed. We thought all of these things throughout the year, despite there being cross currents to the contrary, that a recession was ahead and the Fed was going to stop raising and start cutting, and that we didn't think those things were going to happen. I give us an A. I think we've been right on those things, and we run the portfolios according to that. Stock positioning, I give us an A in that. I think that that we've done a very good job of giving clients diversified portfolios that haven't leaned heavily either toward growth. We've tilted toward value, but we haven't gone super strong toward value. And that year, that's helped client portfolios because we've still included large components of growth in the portfolios where we could have fled growth after the end of last year, and people were concerned about tech stocks, and we weren't. And so we've put up good performance this year with the continued inclusion of all the different sectors in the stock portfolio. In bond positioning, I give us an A+. We have continued to position portfolios toward this higher end of yields that's in short-term bonds, and have continued to give clients good bond yields from that short-term positioning. And you should have seen that in your portfolio. You should have seen a higher level of dividends that has been flowing in to your accounts from these high dividend yields. And so I give us really an A+. I think we've done a very, very good job in that area. Client management, that's an important part of what we do on asset management. Clients have stayed in their portfolios, and clients haven't panicked, and they didn't panic at the end of last year. And that's enabled us to earn returns here in 2023 for clients. And so when I say client management, I mean the way we have managed clients, but I also mean the way you all have managed yourselves. Client self-management, I guess you'd call it. You all have done a fabulous job. And we're really lucky to have the clients we have. And you all have just been great. You've stayed in your seats, and you're getting rewarded here in 2023. And so overall, I give us an A. It's not always going to be like that. I'll give us lower grades, and I don't want anybody to think that I'm not being humble. I'm really just trying to be honest about how I assess our performance. And I hope we'll always get an A, but I can't imagine that'll be the case. There are going to be some times we may get some things wrong. So I'll include this report card. I don't know about every single webinar for every quarterly webinar, but whenever I think it's a good time to give us a report card. All right, some portfolio adjustments that I think may be ahead for us. Core bonds. JC and I have been working on this for the last couple of weeks, and we are likely to make some substantial trades to reallocate the core bond section of the portfolio toward longer duration. We have actually had very short-term, and we have 3 different buckets of bonds: core bonds, short-term bonds, and inflation-protected bonds. And we have been very heavy in allocating to short-term bonds. And we have also allocated to short-term bonds within the core bonds portfolio. So sort of a double dose of short-term bonds. We are about ready to reallocate the core bond sleeve of the portfolio to longer duration, which is more sensitive to an interest rate increase, but we think we're moving to the latter period of interest rate increases. And so you may expect to see trades that go on over the next month, let's say, to affect this, to increase duration in the core bond portion of your portfolio. We are almost done with transitioning over to exchange traded funds. Over the last couple of years, we have been moving away from open-end mutual funds. Nothing wrong with them. We still hold a lot of them. Your portfolio may still have them, but our preference is for ETFs, and we are, I think, in the latter stages of that transition. It's just a better way for us to be able to trade your portfolio, and it's a good way to own securities as well from a tax standpoint. And then the other thing that we're working on is we are slowly, and the emphasis is on slowly, we're looking at some private credit and some private equity stuff. We'll see. We may do something there. We may not do something there. I can't tell you either way. The fees are higher, and we're just trying to see what it's all about. And I always go into that stuff skeptical that somebody's trying to get your money on fees. And I'm still going in that way, but we're taking a look at some stuff. It may lead to something, it may not. Okay, I think that's my last slide. 45 minutes and done. That's pretty good for me. So let me stop there and have Catherine rejoin and see if there's any questions that I can take.
We did have a question come in. It says, how do you decide when to make changes in a portfolio?
Well, good question. We look at, we review portfolios regularly, and sometimes the decision is made to make a change, and sometimes the decision is made to not make a change. And so it really just depends upon, it really depends upon a whole bunch of different readings that are coming in. Interest rates and inflation and valuations and all of those things and more get put into a pot. And so it's not so much of a science as much as it is an art. The current decision that I just talked about, which is to increase the duration in one of the buckets in the models, is the result of a number of meetings that we've had and a number of discussions and a general reading that we could see a fall in short-term rates, as I showed you on that slide regarding the Federal Reserve. And if we see that, suddenly everybody who's excited about their 5% right now could be facing 3% yields. And so what we're thinking is, well, it'd be better for us to lock in a good 4% yield for you over a longer period of time than take the chance that we really do see a sudden fall off in short-term yields a year from now. And it doesn't mean that we're abandoning short-term bonds at all. We have a very large allocation of short-term bonds, but we want to get it a little more balanced after we've gone through this extraordinary period. So that's how we decide. We talk about it and we beat it up, and we talk with other asset managers that are business partners and assimilate it all, and then make a decision. So I hope that answers it. It's sort of a longer term collaborative process. And we don't generally make a decision to make a change, the first discussion. It's usually tabled and it's brought up again a few weeks later and a month later. And then if the readings are still, if the readings are still strongly in favor of the move that's being considered, then we may make that move. Because the readings weren't transitory. So I hope that gives an answer. Also, I want to talk about the conference. We're going to be doing our usual morning session and talking about markets and where they are, and we don't know where they'll be 3 months from now, but they'll be somewhere. And then a really interesting session in the afternoon that we're putting together is going to be about power of attorney, right? People always have questions about power of attorney. I have questions about power of attorney. And we really wanted to focus on this question of power of attorney. When do you need it? Why do you need it? What are the different forms of it? And we're excited about that because we think everyone's going to be able to leave that session with a better idea of power of attorney. So just to give you a little preview about the topics that we're looking at for the conference. Okay, anything else? Any other questions?
Yes, we had two other questions come in. One is, what are your thoughts on how the Inflation Reduction Act will spur or hinder growth and opportunities in the market? There seems like a lot of potential for investments in this area.
Well, I think that's happening. I've heard and read about projects that are getting undertaken because funding has been made available through that act in things like alternative energy. And so I think it's going to have a positive effect. I think it's already in. If the question is what's it effect is it going to have on stock prices, it's already in the stock prices. So those companies that benefit from it, the market already knows that. But I think in general, it is a good sign that the country, and many of these bills that pass are passing with bipartisan consensus. It's popular for us to talk about all of the strife that we have over different issues, but we've had quite a few bills that have passed in bipartisan votes to support the American economy. And I think that's wonderful and very, very positive. And I think the country wants to see more of this type of investment. I think the country wants to see more of our tax dollars spent to build lasting infrastructure and lasting improvements in the U.S. economy. I think a lot of people would be less disappointed paying their taxes if they were getting something for their taxes. It's like anything else. You go to the store, if you get something good for your money, you're happy. You're getting a good exchange. And I think that in general, most Americans back the idea of us investing, whether that investment is going to our area of the world or it's going to another area of our country. somewhere else, some other part where it's benefiting other of our country people. And I think that something like the Inflation Reduction Act, which really was very heavy on infrastructure, really, when it comes right down to it. It was called the Inflation Reduction Act because that's what everybody was worried about when it passed. But I don't know that most of the things that passed in it, it was largely another infrastructure bill. But Lord knows we need infrastructure badly in this country. And so that's a long-winded response to it, but I think the results are going to be positive. And not just to those companies that are involved in doing it, but to all of us who benefit from better infrastructure. Okay, next question.
Okay, last one that's in so far. Do you track and would you share what % of your clients are in each different type of portfolio?
It's a great idea. I'm assuming that means model. It's a fabulous idea, and I should have thought about it. And I think we've done it before, but we will do it and we will publish it in the future. I think we can get that out of our Orion data system pretty easily. And so I know what you're asking for, basically a chart, a frequency chart of how many clients are in Model 6 versus Model 10 or whatever. It's a great idea. And I think we'll go ahead and make that chart. So let's take a note on that, Catherine. And JC would be the person to produce that. She's the Orion expert. It's a great idea to make it's a histogram is what you're talking about. A histogram shows the frequency of occurrences of a certain category. And so what is being asked for, who asked for, I want to know, who had that great
Kelly.
idea? Sorry?
Kelly?
It's a great idea, Kelly. And so it's a histogram of model of number of households that are in particular models, and it's a great idea. So we'll develop that and have that for the future. Thank you for that suggestion. I love it. Any more great graph ideas?
We like our statistics and charts.
Yeah. Any more graphs?
There's no other questions right now.
Well, thank you, everybody. It's a pleasure to have been with you today, and hope you're having a wonderful summer and staying cool and watering your lawns. And hopefully we'll get some rain. We need it. We need it in Houston, and we need it in Columbus. And my understanding is we need it all over the dang place in the U.S. and all over the world. So hopefully we'll get some rain. Thank you, everybody, and take care. Catherine, thanks for all the help. Thanks to JC, who prepared a wonderful slide that I needed at the last minute. And thanks to Casey for holding down the fort. And take care, everybody, and have a great rest of your day.